So welcome back to another episode of the TBE podcast. Today I'm joined by Christopher Mirabile, the founder of Launchpad Venture Group, which is an angel fund based out in Boston. So Christopher, welcome to the show. How's it going today?
Good, thanks.
Thank you so much for your time. Well, how is Boston?
I am based in the fabulous city of Boston, Massachusetts, and things here are good. It's a real hive of entrepreneurial activity with something like 350,000 university students across all the different schools and a lot of life sciences and technology startups. So it's a busy hub of entrepreneurial activity.
Fantastic. Well, let's get started. What did you have for breakfast this morning?
I had my usual, which is homemade yogurt with a little bit of muesli type cereal stirred into it, and a hot cup of tea.
Sounds great. And what is your favorite company right now in the startup ecosystem?
My favorite company right now? Well, I'm pretty interested in a company we just invested in recently that has sort of image analysis software. They're able to detect and image gas leaks in the energy field and also in the industrial safety field. And they have some pretty cool technology. It's a little bit like augmented reality. You look out at a street scene and there's a three-dimensional colored cloud model of the gas leak that's visible. It's pretty cool technology.
Great. And you've had a super interesting career to date, but could you just summarize your career in 2 minutes, please?
Sure. I got out of college in the late 80s, the go-go years when things were really booming in the United States. And despite being an English major, I ended up in strategy consulting, a strategic consulting group at one of the big accounting firms called Price Waterhouse back then. And we did business and strategy consulting for very big companies. And that was super interesting. I really enjoyed that work. Most of the consultants at my level went back to business school after doing it for a few years, and I was one of the black sheep who went back to law school. And I took a law degree that was very focused on business and corporate law, and I popped out into a very busy firm in Boston during the run-up to the dot-com boom, and I was working on lots of mergers and acquisitions and venture capital fund formations and lots of work for technology companies and startups. And one of my clients was a technology company, enterprise software company that was based in Ireland. And they were coming to us because they wanted help going public on the NASDAQ stock exchange. So we worked on that IPO. We got them public in 1997. And I ended up going in-house as an employed corporate lawyer inside the company, ultimately taking over responsibility for global legal operations, and then ultimately became the CFO of the company. And we sold that company in a public company to public company auction kind of a deal. We had was a very interesting story. I can tell it in more detail if you're curious. But long story short, I popped out of the normal job channels and normal career path right at the end of 2008, when the world was kind of in shambles from the 2008 global meltdown, and decided I wanted to do something different. And I began doing angel investing. I thought initially sort of just for a break and, do some networking, and it really became my life's passion. And I've been a full-time angel, running Launchpad, being involved in the Angel Capital Association, running a small fund, and co-founded a software company. So that gets us up to today.
Awesome. So having sold the company in 2008, you launched Launchpad over 11 years ago now. What was the idea behind it, and what is Launchpad?
Well, so Launchpad had been running at the time, and I joined it and then ended up partnering. I had actually created a separate angel network, and we ended up merging mine into Launchpad and partnering up. And I ended up with my partner running Launchpad, and he's now the chairman and focused almost exclusively on our software business, and I'm running Launchpad with another person day to day. And the notion behind Launchpad was really pretty simple. The thing that gets us out of bed in the morning is the idea that entrepreneurship is just vitally, vitally important to job creation, to national competitiveness, and to some extent, social mobility. It used to be that in many developed countries, education was a guaranteed way to improve your place in life. And it still is, but it's less reliably so. And it's still, quite expensive. Entrepreneurship really can have a meaningful change in people's life. And so, really, belief in the power and the importance of entrepreneurship is one tenet. And the next tenet is that it turns out that early stage business angels are vitally important to entrepreneurship, getting companies funded at the early stages so they can go on and grow and do all the great things and create the jobs and the technologies of tomorrow. And when you take a close look at the angel market in any of the developed countries, you see there's still room for professionalizing how it's done. And Launchpad's mission is to professionalize early stage angel investing. We're a network of 150 Boston area active, hands-on early stage investors. And we put about $10 million to work every year in Boston area companies, basically tech-driven and science-driven Boston area companies.
So I'm sure you work with lots of investors, VCs, and private equity funds. But do you think entrepreneurs should go and raise money from angel investors to begin with, or VCs or private equity funds? Or are you a fan of entrepreneurs working with all three?
So the premise of your question is that it's an either or, and of course I reject that premise. It's a both. It's really a stage issue. In fact, I know one of your interests today is to talk a little bit about fund structure, but basically the importance of angels has really grown for a number of reasons. And we can talk about all of them, but one of them is that for sort of reasons of economies of scale and the amount of capital that's gone into the venture world, venture fund sizes have really grown. And as a result, the stage at which VCs can invest ends up being later. They just have larger amounts of money that they want to put to work. And so the larger, more established institutional players like the bigger VC funds have really moved later stage and left a little bit of a vacuum for angels and smaller, earlier stage seed funds to fill. So working with angels is not necessarily a choice, that you choosing angels over VCs. It's really just more a question of what stage the company is at. And just to put it in perspective, in the United States, VCs might back 4,000 or 5,000 companies in a year. Angels will back 70,000. So it's really just a question of angels going in earlier than VCs.
So I'm sure you see a lot of entrepreneurs who come and pitch to you every year. But how do you see a great entrepreneur, and what do you look for in their business?
So how we think about startups, when you're a really late stage investor, like a private equity investor, you are, you really can look at the operational track record of the company, and you can sort of look at the unit economics and the financial results of previous years. And there's a lot of track record to look at. When you're looking at a startup that doesn't have that kind of a track record, you're really looking at three things, right? The team, the market, and the product. And it's really in that order. The rule of thumb with really early stage investing, when it's a speculative market and it's a new product that may not have existed before, is really how special is this team? How creative, driven, tenacious, smart, unified, passionate is the team. That's going to be the most important thing. You can have all the planning in the world, but the only thing you know for sure is that something's going to go wrong or not proceed as planned. And so most early stage investors would say that they would always bet on an A team with a B plan over a B team with an A plan, because the A team will eventually pivot and modify the B plan until they win. And the B team will somehow figure out or be unable to save the A plan as it starts to fall apart.
And talking about the A plan, I saw you were one of the top 3 investment groups in America, which is incredible. But what innovations have you seen over the last 5 years? And what do you think are the top innovations to look out for 2019?
In terms of technologies, obviously there's a lot going on in life sciences around genetics and personalized medicine, and better drug development and better diagnostic tools that are more discriminating and more sensitive. I also think there's very interesting research being done in things like the microbiome. How we're beginning to understand the relationship between gut health and general health. So there's lots of interesting stuff in life sciences. In the technology space, I think we're seeing interesting developments around computational photography and image analysis, sensors, and distributed computing and mesh networking, pushing computing farther and farther out to the edge of the network. Obviously, machine learning and various kinds of specifically applied artificial intelligence, not just artificial intelligence as a generic buzzword, but artificial intelligence really applied to specific business problems. Very, very interesting space. One company I'm working with, for example, terrific little startup, and they come out of the fundraising world, and they are helping universities and hospitals and other nonprofits do a better and more productive job raising money for their organizations. And they use machine learning and artificial intelligence in 2 ways. One, to help the fundraisers better determine who to reach out to. Most fundraisers have a prospect list that far exceeds their ability to contact everyone. So these folks help them figure out who to call, and then they actually use past correspondence as a guideline for creating, using artificial intelligence to create the first draft of the outreach communication. And so in some ways, fundraising is like a CRM game, but this is CRM without a UI. You get in your email inbox, you get the target list of people you should be contacting with machine-created first drafts for you to edit. You edit it, send it, and then you can update the CRM right in the email client with a series of buttons you can click right in the email client. So very, very tailored, targeted, narrow, but powerful use of artificial intelligence and machine learning. Super interesting space.
Awesome. So having also started your own angel investors network, you've also written a guidebook on raising funds. Can you tell us a little bit about that?
Yeah, so part of our mission to sort of professionalize angel investing, in my case, it really that stool has three legs on it, right? One leg is trying to run Launchpad in the most professional and respectful way we can, helping entrepreneurs be respectful of their time, respectful of their ideas, being professional in how we run it. That's one way I do it. Another way, as I mentioned, is the time I've put in over the last decade serving on the board of the Angel Capital Association, which is an nonprofit organization devoted to identifying and disseminating best practices in the early stage investing space. But the third way is when we, as Launchpad's portfolio grew, we've invested in over 105 companies in 17 years. And managing that portfolio with multiple rounds of financing and instruments like convertible notes, converting into stock and warrants and options and so forth, became very complicated. And we set out to try to find a better tool and really couldn't find a good tool. The spreadsheet just doesn't work. So we ended up building our own tool to manage our portfolio. And then one thing led to another. People wanted to use it. We ended up developing a long list of features that people wanted. And before we knew it, we were nurturing a little SaaS business for people using this web application as sort of like a combination of Quicken and your mutual fund statement. And as part of that, we've used that website as a platform for doing a ton of writing. My partner and I have probably at this point written somewhere in the neighborhood of 250 pieces of thought on various aspects of angel investing and the early stage investing space and evaluating companies and dealing with risk. And one of the areas that we wrote about is our experience as fund managers and working with other fund managers. We did a book on, I think it was our fifth book, and it was just on how to build and manage an early stage fund.
And from that, how easy is it to raise a fund?
It's really not easy. It's if you think about it. There's just a tremendous amount of judgment associated with early stage investing. As we said, it's not like you can pick stocks on a stock exchange. These are, young first-time entrepreneurs going after markets that maybe don't exist with products that haven't been built yet and maybe can't be built. What could possibly go wrong? So there's a tremendous amount of judgment that is vested in the general partners of a fund who are making those decisions. And failure is a huge part of early stage investing. It's not unusual for 40 or 50% of the companies in a portfolio to fail. So limited partners who are putting up the money to give to a fund are skeptical. It's a sophisticated business. There are a lot of funds competing for their dollars, and there's a whole industry associated with benchmarking the performance of funds. And if you walk into that world as a first-time fund manager who's never raised money before, has no experience investing, it's going to be very, very difficult to compete. And I know a lot of people who over the years have tried to raise funds who haven't been successful at it. In most cases, the people who are successful start out with either a limited partner who knows them really well from another context and is willing to back them on a modest basis to begin getting started and building a little bit of a track record. Or it's an entrepreneur who had tremendous success with his or her first company and has a little bit of their own wealth to seed the fund, and a real entrepreneurial success track record. And that's enough to get people to make a commitment and get the fund started. But it's a difficult industry to walk into and just get people to to hand you money. Very difficult.
So for any of our audience who are looking to raise a fund, if they don't have any track record, how would you persuade investors to back you?
Well, one way is to convince them that you can get them access to fantastic deals and opportunities that they couldn't get to otherwise. In other words, say, hey, you want to be an angel investor, but you don't have the time. You want to be an early stage investor, but you don't have the time. Let me do it for you. Another way is keep the fund small and make it clear that your own resources are going to be a significant part of every investment. In other words, a typical larger scale fund, the general partners might own 2, 3, 4% of the fund. But if you're trying to get started, you could sort of say 20% of the fund will be my own money. So you can trust me with your money because I'm investing my own money alongside yours. That can be a way to do it. Another way that you can sometimes get started and build a track record is a deal by deal fund where you go to the LPs and you, rather than saying, give me a large chunk of money committed on a multi-year basis, that's sort of an irrevocable commitment to the fund. Instead, you say, let's do this deal by deal. And I'll go find the deals and I'll bring them to you. And if you like them, then you can back the company. And that can be a way of getting started as well. It can be tricky. Another example is specialty situations. I know of a fund that was formed by some people who were running an association of accelerators, startup accelerators. And the premise of their fund was back us because we're going to use the money to cherry pick the best companies from all the accelerators in our network around the world. And so people said, okay, I'll back those guys because they're going to see an unusually broad set of deals, and they're going to have a mechanism for figuring out which of those deals are the best.
So if we go back to basics, if someone was to go and raise a fund tomorrow, where would they start and how would you recommend raising the money?
I think probably if you really were starting from scratch, I think probably it's a networking game as much as anything. It's people who already know you and trust you, who have some investable net wealth. They have enough that they can afford to have a high risk allocation in their investment portfolio. Every investment portfolio should have mostly conservatively invested money, but some more aggressively invested money. And if you could find someone who knows, that you're a fine, upstanding person with a good judgment, and you can get them to back you based on their personal knowledge of you, you can then sometimes ask them for introductions to other people who might be interested in what you're doing. Talk to that person. If they're not interested, before the conversation is over, ask them if they can introduce you to someone who might be, and literally just using the 3 golden networking questions, work your way around, trying to bootstrap off of some small early commitments from people who know and trust you.
So you are a seasoned entrepreneur and investor, if I may say so. But what are some of the booms and busts you have seen in the investor space over the last 10, 15 years?
Well, I mean, there are frequently periods of time where people, I think Gartner captured it well in sort of their hype cycle chart. There is always a pattern where a new technology comes along and people's enthusiasm for the technology outstrips their common sense, and they start attributing superpowers to the technology, and it may have the ability to make changes, but it's not going to be that fast. I mean, the .com boom was a perfect example of that. and early investments in robotics in the 70s and manufacturing was another example of that. And obviously we've just gone through a ridiculous, crypto assets boom and bust. It's technology is a means to an end, not an end in and of itself. And it is rightfully at the center of things. I mean, one of the things we say to startups all the time is that their biggest competition is inertia. It's the already familiar and good enough solution that people are already using. And as a general matter, people fear change and they don't like to waste effort. And so it's very, very difficult to get people to make a change. So as a general matter, to get people to make a change, your product or service has to be sort of something on the order of 10x better, faster, or cheaper to really get people's attention. And it's easy to have that kind of a leap forward with a new technology. It's not so easy without. For example, it's hard to make a restaurant meal that's 10x better, faster, or cheaper than the restaurant down the street. But if you come up with a new technology like the internet or a different kind of chip or some other really amazing innovation of miniaturization or power, you can drive new business models and create new leaps forward. And so people's enthusiasm around technology is not misplaced. It does have the ability to create whole new markets and great leaps forward, but gravity still applies. Many aspects of startups became cheaper once the internet became mainstream. It was cheaper to talk to your customers. It was cheaper to get in front of customers. It was cheaper to do advertising. We had bandwidth became cheaper. Programming languages became more advanced, but rent still cost the same. Salaries still cost the same. So this notion that that suddenly all the rules of business were changed overnight because of the internet was ridiculous. And you had companies literally doing IPOs where they were selling furniture over the internet and they were losing money on a unit basis on every piece of furniture that they sold. It just doesn't make sense. And so often it takes a while for the original enthusiasm to kind of settle down and for people to take a sort of second, more clear-eyed look and really begin to leverage the value of technology after some of the dust has settled.
Well, you touched upon one of my questions there, cryptocurrency. What do you think of it? Are you a fan, or do you think the whole crypto world is just going to tank anytime soon?
So I think that distributed ledger, blockchain, the technology that underlies blockchain is a potentially very interesting piece of computer science that has some real potential, real applicability. It's this self-proving transaction where two strangers can transact and they can be comfortable that they can trust each other without a central party vouching for either of them. That has use in business, things like smart contracts and so forth. So I think the underlying technology has potential. I think the potential of the technology is still in the stage where it's being a little bit overhyped. In many cases, it is not the simplest way to do things and necessarily even the most efficient or the best. But I think it has real potential. I'm very excited about applications like smart contracts and different sorts of exchanges and marketplaces. For example, one of the things I've long believed is that I wish we lived in a world where I could pay 1/100th of a cent to read a web article instead of having my browser completely crushed with privacy invading and tracking ads. But micropayments are not practical. The credit card processing costs and so forth. But it's possible that distributed ledger technologies may allow things like micropayments to work. That would be super cool. Crypto, on the other hand, I think is probably headed for additional difficulty in the near future. I think that there was a tremendous bubble. A lot of investors, a lot of the crypto assets were bid up with fraudulent means, pump and dump. I think the SEC has sent out well over 100 subpoenas investigating various things. And I think that a lot of the demand came from retail investors in places like Asia. And I think that boom we're going to take a long time for the value of crypto assets to ever come back. And I think that we have a lot more crypto assets than we really need at the moment. Long term, I wouldn't bet against the technology, and there's some very interesting use cases. But one of the things that's so fascinating to me, and I haven't gone back and chased this to ground, but I recall reading that when things like Bitcoin, crypto assets first came out, governments around the world, including the U.S. Treasury Department, were sort of horrified. Oh, this is this threat to our sovereign fiat currency, and it's allowing people to transact on the dark web, and it's anonymous, and we got to stop this and regulate it. And then apparently, according to urban legend, the U.S. Treasury Department stopped and thought about it for a minute, and they said, wait a second, every transaction on these blockchains is recorded in public. This, compared to a duffel bag full of currency, this is infinitely more traceable. Why would we ever want to stop this? This is a boon to law enforcement. And so I think one of the funny things about this is how people misunderstand the privacy and security aspects of some of these currencies. But in any event, I think it'll all settle down, and we'll find some use cases for it. And I think probably before our lifetimes are over, crypto will very meaningfully change the world's financial systems. Probably not as much as people think, and not as fast as people think, but I think in the end, it will have an effect.
Well, last night I spoke to Avichal Garg from Electric Capital, who you may know, who runs a crypto asset management ventures fund. And we were discussing about the whole regulation around crypto. What do you think is going to happen to the regulation? And do you think the government, so here in the UK is the FCA, in the US is the SEC, do you think they really will start to crack down on it, or has it already happened?
Without a doubt, they will. In fact, a couple of months ago, I spent a day in Washington doing some public policy work for the Angel Capital Association, and sat with 4 of the 5 SEC commissioners. And after speaking to each of them in their offices in person, one at a time, there is no doubt in my mind that the SEC plans to continue coming down extremely hard. And don't forget, from my bio, I'm a recovered corporate and securities lawyer. So I'm knowledgeable about the underlying legal construct. And there is no doubt that these tokens and coins are unregistered securities, and that these one of the, in fact, it was the chairman Clayton of the SEC was joking and said there's 3 kinds of securities offerings: registered, exempt, and illegal. And these offerings, at least in the United States, fall into the illegal category. They're not exempt and they're not registered. So there's no doubt in my mind that a very hard rain is going to fall in the regulatory space in the crypto world in the United States.
Well, time will tell. But going back to raising a fund, if you were to give some advice to someone who's looking to set up a fund, how much should they go and raise as a first-time fund?
Well, I guess the glib answer is as much as they can get, but it's actually more complicated than that. It depends a little bit on the type of partnership they're going to build and the type of asset they're going to invest in. With a small partnership of 2 or 3 people, putting $100 or $150 million to work in the seed stage is very, very difficult. You need tremendous deal flow, and you're working 24 hours a day, because a lot of these companies are only raising $1 million or $1.5 million or $2 million at the very, very early stage. And you don't want to do the entire round yourself, because you'll end up having sole responsibility for guiding and advising this company and helping them fill their next round and so forth. So even if you only have one other investor, you're limited to $500,000 per company. And if you're trying to put $100 million to work at $500,000 at a time, that's 200 companies. And that's 100 companies for each of 2 partners to manage. It's just extremely difficult operationally and economically. So there is an upper limit to the amount of money you can raise. And likewise, there's a lower limit, because when you think about the fund structure of the typical fund in terms of the management fee and the carry on profits, a fund of $5 million or $10 million is not going to generate enough management fees to pay any kind of meaningful salary for a team of 2 or 3 people. So there's sort of a minimum size. You can do it if you're already in the space doing something else, or if you don't need the current income. But if you're going to try to be a young first-time fund manager, if you really think about it, first of all, if it's a $10 million fund, you and your colleagues are expected to account for 4% of the fund. So you're going to have to come up with that money. And what a lot of fund managers do is they defer their management fees as a form of buy-in into the fund. So basically they pay their management fee right back into the fund to fund their buy-in. So you're not getting any management fee in the early years. And investing in startups has a holding period of 7-8 years for the good successful acquisitions in your portfolio. So you're not going to get any carry until you've started to have companies sell and you've paid back the entire fund and you're getting into the profits. So just as there's an upside, an upper limit to what's manageable investing in startups, there's also a lower limit to what's practical. So that's why you tend to see a lot of funds in the sort of $20 to $70 million range. It's big enough to support a team, but small enough to play in the seed space and get meaningful parts of small rounds and have a manageable number of deals per partner.
So if someone was to raise a first-time fund at, let's say, $15 to $20 million, how long do you think that would take to raise? And what are the key legal pieces of information they need to think about?
Well, funds can either be set up as a partnership agreement or as a company like a limited liability company where they're membership units. So the legal notion is to make sure that the fund is structured in a tax efficient way in the jurisdiction where the fund resides, and that it is securities compliant. In the United States, for example, there's a big carve out for venture capital funds. So the ownership interests that they issue are exempt, and they're investing as essentially an accredited investor in exempt Reg D deals. And you'd need to make sure you had an analogous set of laws in your own country. But most developed economies that have an active venture community are going to have those kinds of exemptions. And then you need to sort of lawyer up and paper up your agreement and make sure that it has provisions in it for all the various contingencies, and specifies how risks are going to be allocated and how the parties are going to conduct, for example, basic things like how much reporting and information are you going to give to your LPs, basic information around how many capital calls are you going to do. It's fairly typical for a fund to start out with a capital call of 1/3 of your commitment on day one, and then 1/3 after a year or maybe 18 months, and then the final third a year or so after that. And most funds sort of are 10 to 12 year lifespan, and they do the majority of their investing in the first 2 to 3 years. They're pretty much adding all their companies that they're going to invest in the first 2 to 3 years. And then in the next 2 to 3 years, they're busiest with their follow-on investments as they begin to figure out which of them are winners, and they're putting the money into those. So, and then the remainder, if that's 4 to 6 years, pretty much the money is spent at that point, and you've already started to raise your next fund. And you're managing the first fund and managing those companies, helping them trying to drive exits and get them acquired. And in some cases, you'll have a little bit of dry powder and you'll put it in there, but you have to specify all those kinds of things in your documents. When is the money going to come in from LPs? Does the fund have a contractually agreed upon thesis for the type of companies it's going to invest in? Is there a limit on the maximum size of an investment? For example, no company in the portfolio will constitute more than 5% of the fund or 10% of the fund. All those kinds of things need to be papered up in your agreement. And I think it's probably a false economy to go try and find a lawyer who can figure all that stuff out on the fly. You probably want to work with a lawyer or a solicitor who has some experience in that space. And you probably want to start by showing your LPs a term sheet rather than finished documents, because some of the LPs may impose special terms or want changes to the terms. And you may end up making special concessions to your anchor LPs who are the first to commit to you. They may, for example, not pay a management fee, whereas the other people will. So if you spend a fortune getting all the documents perfectly polished, some of that work could be wasted because some of your LPs will want different terms. And so boiling it down into a fairly detailed term sheet to show to your LPs is probably optimal. And then once they agree to that, then you can have a closing where they sign the documents and make their first capital call, fund their first capital call.
So having launched your own angel network funds, you haven't launched your own venture funds. Do you have plans to do that?
Well, Launchpad operates as a network model, so we all are managing our own portfolios. I'm an angel investor with my own sort of two-legged portfolio of my own investments. And my partner Ham and I also are LPs in a fund that is really just like a seed venture fund. We have we're GPs, we're general partners. We run a fund and we have 3 LPs. So it's a small fund with a small number of investors and operates just like a mini VC fund with all the sort of stuff we talked about.
Awesome. And to summarize, would you recommend someone then to start their own fund?
I think it's incredible work if you can do it. You're constantly surrounded by interesting ideas and cutting edge technologies with the power to really change and shape society. And I think working with entrepreneurs, entrepreneurs are almost pathologically optimistic. And investors are smart, curious people. And so if you can get it to work, yeah, I think it beats digging graves or something. There are definitely harder jobs out there, but it is hard to get started. But I think it's fascinating work with a real potential to make a difference if you can get yourself started.
And do you have any great books you can recommend for anyone looking to start their own fund?
I think you're asking me to plug my book, and the answer is that we did write a book on managing, starting and managing venture funds, and we've also written other books on various aspects of evaluating and investing in early stage companies. And you can find them wherever books are sold. They're which these days is Amazon. So a lot of if you search Christopher Mirabile on Amazon, you can find all the books, and you can also find free versions of everything we put in the books on our website at seraph-investor.com.
I've read them and I would highly recommend them. So go and check them out.
You're too generous.
And to summarize, what's the final piece of advice you would give to a entrepreneur?
I think if you're someone who just can't not pursue this idea, and you accept the notion that it's going to be difficult, I guess my advice would be not to give up. I can't tell you how many success stories I've heard that really are reducible down to a story of persistence. You can't just keep pounding the same idea if it's not in a workable form. You have to be willing to adjust it and listen to your market and really take on board what the world is trying to tell you. But provided you're willing to adapt what you're doing, and be flexible in your approach, if you really feel compelled to do something, just keep after it, because persistence is a very important part of almost every, if not all, success stories.
Well, Krista, thank you so much for your time. It's hugely appreciated. So much information, and good luck for the future.
Thank you. Take care, Ollie. Pleasure being with you.